In a recent video, this housing collapse is way worse than 2008, and they're hiding it. Tom Bilyeu argued that the U.S. housing market may be entering a phase that could ultimately prove worse than 2008. He talked about home prices at all-time highs, affordability at multi-decade lows, supply being structurally locked, and an entire younger generation increasingly convinced they may never own a home. And I want to be very clear from the very beginning. Everything Tom described is accurate. None of it is exaggerated. None of it is emotional speculation. The data is real, the numbers are real, and the anxiety many people are feeling right now is completely understandable. But if we stop at describing the symptoms, all we're left with is fear. When we place this entire story inside the framework of long-term economic and monetary cycles, something very different happens. The chaos starts to organize itself, patterns emerge, and more importantly, we begin to understand where we are in the cycle and what actions actually make sense at this stage. So I encourage you to listen to this video all the way through. Not because I'm going to tell you whether the market crashes tomorrow or next year, but because I want to help you understand which phase of the cycle we're in, why what we're seeing was almost inevitable, and how to position yourself without getting dragged around by collective panic. If you find this analysis useful, consider liking the video and saving it. This is the kind of framework you'll want to revisit as conditions continue to tighten. To understand how U.S. housing ended up here, we have to go back to the aftermath of the 2008 global financial crisis. After that collapse, the United States, and much of the developed world, entered a completely new monetary era. Interest rates were pushed down to near zero and kept there for years. Multiple rounds of quantitative easing were introduced. Liquidity was injected to prevent systemic failure and later to stimulate growth. At first, that made sense. An economy recovering from a financial shock needs support. But when ultra-low interest rates stop being a temporary emergency measure and become a permanent feature for more than a decade, the consequences begin to compound. Cheap money for a year or two is stimulus. Cheap money for 10 years fundamentally distorts behavior. When capital is cheap for too long, decision-making changes across the entire system. Home buyers stop evaluating assets based on long-term value and instead focus on monthly payments. Investors become comfortable with leverage because the cost of capital feels negligible. Businesses borrow aggressively under the assumption that rates will stay low indefinitely. Over time, the system adapts to a world where money is almost free. This period corresponds to what we can call summer in the economic cycle, the expansion and boom phase. Growth appears stable, asset prices rise, risk feels manageable, credit flows easily, and housing becomes a favored destination for excess liquidity. Real estate during this phase is almost ideal. It's tangible. It's easy to understand. It can be financed with long-term debt. And culturally, it's perceived as safe. Capital flows into housing not because incomes are surging or productivity is exploding, but because money needs somewhere to go. Home prices begin to rise faster than wages, faster than economic growth, and faster than true affordability. This dynamic reached an extreme during 2020 and 2021. When the pandemic triggered one of the largest monetary expansions in modern history. Central bank balance sheets exploded in size. Liquidity flooded the system. Asset prices, especially housing, accelerated sharply. That wasn't a normal expansion. That was the late stage of summer pushed to its absolute limit. But no summer lasts forever. Summer ends not because prices are high, but because inflation eventually forces a policy reversal. When the cost of goods and services rises too quickly, central banks are forced to react. And in 2022, we saw one of the fastest monetary tightening cycles in over 40 years. Interest rates rose rapidly. The cost of borrowing jumped. 30-year mortgage rates moved from the low 2% range to 6 to 7% in a very short period of time. And this shift did not immediately crash home prices. Instead, it crushed affordability. This is where many people misunderstand the mechanics. They assume higher rates automatically mean lower prices, but that's not how markets transition. When rates spike quickly, the first thing to disappear is not price, it's the marginal buyer. These are buyers who could only afford a home when rates were exceptionally low. When monthly payments increase by several hundred or even thousands of dollars, they simply exit the market. Prices can remain elevated, but liquidity collapses. Transaction volume drops sharply. The market enters paralysis. Buyers can't buy, but sellers don't want to sell because they're locked into historically low mortgages from the past. This is the defining characteristic of autumn in the economic cycle, the late cycle tightening and deceleration phase. Autumn is not a dramatic crash. It's an uncomfortable stagnation. Prices stay high. Supply is constrained. Confidence erodes. Something feels fundamentally wrong, but the system hasn't broken yet. And what Tom described in his video aligns perfectly with late autumn in the housing cycle. A major paradox dominates the current market. Buyers can't afford homes at today's rates and prices. Sellers refuse to sell because giving up a 2 to 3% mortgage makes no financial sense. With supply structurally frozen, prices can remain elevated even as the economy weakens underneath. So what actually pushes the market into the next phase? Not headlines, not fear, not high prices. The real trigger is always cash flow. Winter in the economic cycle, the contraction, deleveraging, and recessionary phase, does not begin when people are scared. It begins when they can no longer sustain cash flow, when unemployment spreads into the middle class, when business revenues decline, when credit tightens, and when those who once refused to sell are forced to. Forced selling doesn't happen because interest rates are high. It happens when income disappears. A 2% mortgage offers no protection if you can't make the payment at all. That's when properties re-enter the market, not out of greed, but out of necessity. Right now, many of the structural pressures of winter are forming, even if the collapse itself hasn't arrived yet. U.S. government debt is at historic levels. Interest expenses are rising rapidly. Policymakers are trapped. Rates can't stay high forever without crushing the economy, but cutting too soon risks undermining confidence in the currency. Historically, rate cuts are not a sign of strength. They're a response to weakness. And when credit is already damaged, lower rates alone cannot instantly restore affordability or confidence. That's why this moment is not about panic. It's about positioning. And positioning at this stage of the cycle is about buying time. When I say reducing leverage is buying time, I don't mean selling everything immediately. I mean reducing your dependence on borrowed money. If you're holding assets where cash flow is extremely fragile, where even a small disruption creates stress, that's a signal you're over-leveraged for this phase. Reducing leverage can be as simple as not taking on new debt, avoiding cash-out refinances, or not using existing assets as collateral for new investments. Every step away from leverage gives you more breathing room. When I say maintaining liquidity is buying time, I'm talking about preserving flexibility. Liquidity isn't just cash in a bank account. It's the ability to meet obligations, absorb shocks, and make decisions without being forced into selling assets at the worst possible moment. In autumn, liquidity is not for speculation, it's for optionality. The ability to wait is a powerful advantage in a tightening cycle. And when I say not taking on new risk is buying time, I mean avoiding situations where a small downturn could create irreversible damage. This is not the phase to chase returns out of fear of missing out. It's not the phase to expand into assets whose cycles you don't fully understand. Every new risk added in late autumn reduces your odds of making it cleanly through winter. Now, holding cash doesn't mean passively accepting inflation erosion either. Cash in autumn is not meant to chase returns, but it doesn't have to sit completely idle. If inflation risk concerns you, allocating a portion of that liquidity into defensive assets, such as gold or silver, can help balance risk. The key is intentional allocation, not emotional reaction. I've discussed extensively that gold and defensive assets also move in cycles of their own. They don't rise randomly. They respond to specific monetary and economic conditions. If you want to better understand when holding cash makes sense, when defensive positioning makes sense, and when transitions occur, I encourage you to watch my previous video on the seasonal cycle of gold. The goal here is not to predict tomorrow's market, but to move through this entire cycle without making irreversible mistakes. Tom is right about the present. The cycle explains why it's happening now, and why it isn't over yet. In investing, the winners are not those who identify bad news first. The winners are those who understand the cycle, preserve discipline, and act in alignment with the season they're actually in.